The breakaway pattern is essential for traders and investors as it signals the beginning of a new trend. This pattern often appears after a prolonged price consolidation, indicating a potential shift in the market's direction. Understanding the breakaway pattern is vital for making informed trading decisions. There are known variations and similar patterns to the breakaway pattern that provide additional clues about potential trend reversals. One such variation is the gap pattern, which occurs when there is a noticeable space between two trading periods, suggesting a strong shift in market sentiment. Another related pattern is the exhaustion gap, which signals the end of a trend and the start of a new one. This pattern typically appears after a rapid and significant price movement, indicating that the trend may be losing its momentum. Furthermore, the island reversal pattern, often considered a variation of the gap patterns, occurs when the price gaps in one direction, forms a small trading range, and then gaps back in the opposite direction, leaving an island of price action disconnected from the main chart. This pattern can signal a powerful reversal of the existing trend. Recognizing these variations and similar patterns can help traders distinguish between different types of market shifts and adjust their trading strategies accordingly. By carefully analyzing the appearance and context of these patterns, traders can enhance their ability to predict future market movements and make more informed investment decisions. Technical analysis serves as a cornerstone for investors aiming to predict the future movements of market trends. At the heart of this approach lies the observation of complex patterns. These patterns form a vital tool for traders by offering a nuanced understanding of market sentiment. Such a sophisticated view is made possible through the integration of various technical indicators, including candlestick formations, trend lines, and a multitude of other analytical tools. These elements collectively provide a glimpse into the strength and possible continuation of prevalent market trends. Within the sphere of technical analysis, complex patterns stand out due to their ability to encapsulate more intricate market dynamics compared to basic patterns. They often encompass a series of price movements and indicators that, when combined, signal the potential for a trend to continue. For example, a pattern might involve a particular configuration of candlesticks suggesting a continuation of an uptrend or downtrend, reinforced by trend lines that align with this directional momentum. Candlestick formations, pivotal to these patterns, give insight into the market's emotional landscape by illustrating the struggle between buyers and sellers in a given time frame. Trend lines, on the other hand, serve as visual guides that highlight the direction of market movement and help identify areas of support and resistance. Other indicators, such as moving averages or relative strength index (RSI), add layers of confirmation by indicating the strength behind a trend and the likelihood of its persistence. For traders and investors, understanding these complex patterns is akin to deciphering a map of market psychology and momentum. It allows them to forecast with greater accuracy where the market could head next, based on the premise that history often tends to repeat itself in the financial markets. This predictive capacity, rooted in technical analysis, empowers investors to make more informed decisions about when to enter or exit trades, aiming to capitalize on the continuance of established market trends. Complex continuation patterns such as flags, pennants, wedges, and rectangles often emerge during pauses in a market trend. These patterns play a crucial role in consolidating the market before it resumes its previous movement. Identifying these patterns involves looking for distinct formations. Flags and pennants are identified by their small bodies, which are encased within converging trend lines. This makes them resemble their namesakes, with flags appearing more rectangular due to a short, steep price movement followed by parallel lines of consolidation, and pennants forming a small symmetrical triangle that results from converging trend lines. Wedges are recognized by their narrowing price range. They form through price movements that converge into a point, giving the appearance of a wedge. This pattern can signal either a bullish or bearish continuation, based on which way the price breaks out. Rectangles are identified by their parallel trend lines. They form when the price moves between two parallel horizontal lines, creating a rectangular shape. This pattern indicates that the market is taking a breather before continuing in the direction of the prevailing trend. Understanding these patterns requires observing the market's behavior during periods of consolidation and identifying the formations described. By doing so, traders can gain insights into potential market movements once the pattern completes and the market resumes its trend. Continuation patterns in the financial markets provide a clear indication of underlying market sentiment, suggesting that the current trend, despite experiencing temporary pauses, has the strength to persist. These patterns, such as triangles, flags, and pennants, signal a phase where the price action consolidates. This consolidation phase is crucial. It represents a period of accumulation if the trend is upwards, or distribution if the trend is downwards. During this phase, investors and traders are essentially pausing, reflecting on the current price levels, and deciding whether to continue supporting the prevailing trend. The consolidation seen in continuation patterns is a battleground of sorts, where the conviction of the trend's followers is put to the test. If the sentiment remains strong, the pattern resolves with the market moving in the direction of the existing trend, demonstrating the collective agreement among market participants that the trend's underlying reasons remain valid and strong. For example, in an uptrend, a flag pattern emerges as prices begin to move sideways or even slightly downward, suggesting that buyers are taking a breather and assessing their positions. However, because the overall sentiment is still bullish, the accumulation of assets during this period eventually leads to a breakout, continuing the upward trend. This is a clear signal that the market participants believe in the sustainability of the uptrend and are willing to invest more, driving the prices up further. In essence, continuation patterns act as a reflection of the market's heartbeat, showing pauses in the rhythm that are natural and necessary for a healthy market flow. They reassure investors that the market sentiment remains intact, promising the continuation of the trend after a short period of contemplation and adjustment. In the context of financial markets, complex patterns play a pivotal role in forecasting the direction of market trends. By definition, these are indicative of trend continuation, meaning they suggest the current market trend is likely to persist. It is crucial, however, to understand that their effectiveness and reliability come into play only after these patterns have been completed and followed by a successful breakout. A successful breakout occurs when the price of an asset, whether it's a stock, commodity, or currency, moves beyond a defined boundary of the pattern, either a resistance or support level, with significant volume. This movement confirms the pattern's role as a continuation pattern, reinforcing the existing trend's direction. Whether an uptrend or downtrend, the confirmation of these patterns suggests that the trend is expected to continue in the same direction. Understanding these patterns is essential for investors and traders as they provide strategic insights into future market movements. Recognizing and interpreting these patterns correctly can lead to informed decision-making about when to enter or exit the market, thus potentially leading to more favorable investment outcomes. Volume plays a pivotal role in confirming the continuation of complex patterns in financial markets. When a pattern, such as a triangle or a flag, nears its completion, traders often seek confirmation that the anticipated move will occur. An uptick in volume as the price breaks out from the pattern offers this confirmation, acting as a strong indicator that the move has significant backing. Essentially, more participants are engaging in the market at the breakout point, which adds validity to the expected continuation of the trend. This increase in volume isn't just a number. It's a signal of consensus among traders and investors, revealing their collective belief in the direction of the market move. Aside from volume, other technical indicators contribute valuable insights into the potential continuation of market trends. Moving averages, for example, can smooth out price data over a specified period, offering traders a clearer view of the underlying trend. When the price action post-breakout remains above a key moving average, it reinforces the likelihood of a continuation. Similarly, momentum oscillators, which measure the speed and change of price movements, can indicate whether the market is in an overbought or oversold condition. If an oscillator shows momentum building in the direction of the breakout, it serves as further confirmation that the trend is likely to persist. Together, these tools form a comprehensive toolkit for traders looking to validate the continuation of complex patterns. Volume, as the cornerstone of this validation process, provides the initial assurance needed to consider a position. Its confirmation, coupled with supporting evidence from moving averages or momentum oscillators, builds a robust case for the anticipated direction of a market move. This multidimensional approach enhances traders' confidence in their decision-making, guiding them through the complexities of financial market analysis. Complex continuation patterns are considered to be among the more reliable tools in technical analysis due to their ability to signal the continuation of an existing trend. These patterns emerge over time and reflect the consolidation phase of the market, after which the prevailing trend is likely to resume. Examples of such patterns include flags, pennants, and wedges. While these patterns have a high degree of reliability, their predictive power significantly increases when used alongside other indicators and market analysis techniques. It's essential to understand that no single tool can provide absolute certainty about market movements. Therefore, combining continuation patterns with other forms of analysis such as moving averages, volume indicators, and fundamental analysis can lead to a more comprehensive market view. Incorporating multiple indicators allows for the validation of the signals provided by complex continuation patterns. For instance, if a flag pattern suggests that a trend will continue, confirming this prediction with a rising volume indicator can provide additional confidence in the signal. Similarly, aligning the pattern's prediction with the overall market sentiment and economic indicators can ensure that the analysis is in tune with broader market dynamics. In summary, While complex continuation patterns are powerful technical analysis tools on their own, integrating them with other analytical techniques enhances their accuracy and reliability. This holistic approach to market analysis increases the chances of making well-informed investment decisions, leveraging a variety of perspectives to navigate the intricacies of the financial markets. Integrating complex continuation patterns with other technical analysis tools provides a more comprehensive market analysis. For instance, the Relative Strength Index, or RSI, can be used to identify overbought or oversold conditions within these patterns. When the RSI indicates an asset is overbought, it means the asset might be overvalued and could see a price correction. Conversely, an oversold condition could indicate an undervalued asset, potentially leading to a price increase. This information can be crucial for deciding the best entry or exit points during the continuation of a pattern. Another useful tool is the moving average convergence divergence, commonly known as MACD. This tool helps in confirming momentum changes. For example, a bullish momentum is confirmed when the MACD line crosses above the signal line. This can be a strong indicator that the continuation pattern is likely to persist in the expected direction, providing a reliable signal for investors to consider a strategic move in the market. By combining complex continuation patterns with the RSI and MACD, investors get a clearer, more nuanced view of the market's current state and its likely future movements. This holistic approach allows for better informed decisions, balancing the geometric precision of pattern analysis with the dynamic insight provided by momentum and market sentiment gauges. In the continuation of complex patterns, especially when analyzing financial markets, there are several common pitfalls that analysts and traders often encounter. One of the most frequent mistakes is mistaking a consolidation pattern for a reversal signal. Consolidation happens when the price moves sideways, indicating that the market is taking a pause after a significant move. It's essential to understand that this does not necessarily signal a change in the market's direction. Misinterpreting this can lead to premature trading decisions. Another key mistake is failing to wait for a confirmed breakout before acting. A breakout occurs when the price moves beyond a defined support or resistance level, potentially signaling the start of a new trend. It's crucial to wait for confirmation, typically through additional price movement or volume indicators, to ensure that the breakout is genuine. Acting on an unconfirmed breakout can lead to entering or exiting a position too early, resulting in possible losses. The importance of patience and confirmation cannot be overstated in trading. Jumping into trades based on unconfirmed signals or misinterpretations of market patterns can lead to significant financial losses. It's advisable to perform a thorough analysis, wait for clear signals, and confirm these signals with additional indicators before making trading decisions. This approach not only helps in avoiding common mistakes, but also in making more informed and potentially profitable trading decisions. In trading, complex continuation patterns serve as indicators that the current market trend is likely to continue once the pattern is completed. Utilizing these patterns strategically involves carefully determining both entry and exit points to maximize gains and minimize potential losses. One effective approach entails waiting for a confirmed breakout from the pattern before making an entry. This breakout is recognized as a closing price outside the pattern's boundary, signifying a potential continuation of the prior trend. Once a breakout occurs, setting an entry point is critical. Traders often enter the market after the price closes beyond the pattern's boundary, ensuring the movement isn't a false signal. For an exit strategy, the pattern's height or width, depending on its orientation, can be projected in the direction of the breakout to establish a target price. This method gives a tangible goal and helps in quantifying the potential profit from the trade. Risk management is an inseparable part of trading with continuation patterns. To guard against the possibility of a false breakout, which can lead to losses, traders usually set stop-loss orders just outside the pattern's boundary on the opposite side of the breakout. For example, if the breakout is upward, the stop-loss is placed just below the pattern's lowest point. This position minimizes the potential loss if the market reverses direction unexpectedly. Employing these strategies requires careful analysis and discipline. It is crucial to wait for clear signals and confirmations rather than acting on presumptive breakouts, as the cost of entering prematurely can be significant. By combining thoughtful entry points, calculated exit targets, and prudent risk management techniques, traders can use complex continuation patterns to make informed and strategic trading decisions.